Welcome to Sheen Research, your strategic partner in comprehensive investment analysis.
Today, we are taking a very close look at one of the giants in the alternative asset space, ARES Management Corporation, ticker ARES.
That's right. And our focus is specifically on their third quarter 2025 results, the period that ended on September 30th.
And our mission here is, pretty clear. We're going to investigate, debate, and really synthesize the financials.
We're not just reading numbers off a page. We want to stack Q3 directly against the quarter that came before it, Q2 2025.
Exactly. Because that comparison is where you really start to see the shifts, the momentum.
You can test whether management strategy is actually working. It's about getting past the headlines and understanding what's truly driving the growth engine at a company like ARES.
I'm glad you used the word engine because the story of Q3 2025 is really one of acceleration. I mean, they spent the first half of the year raising capital, building up that dry powder.
And Q3 was when they started putting it to work.
They hit the gas, they started deploying capital, and maybe more importantly, started monetizing some of their big wins. We have the 10Q, the investor slides, the call transcript, all the source material we need.
So we need to figure out the cost of that acceleration, the risk, and whether this base is sustainable.
That's the key question.
Okay, let's get into it. We should start with the foundation. The headline numbers for Q3 2025. And just looking at them, they seem undeniably strong.
Oh, they were. The top line was lit up, primarily by a huge surge in performance fees.
So let's put a number on that. What was the total revenue, according to GAAP, for the 3 months ending September 30th?
The official number was $1,657,628,000. So let's just call it roughly $1.66 billion.
$1.66 billion in a single quarter. That's a staggering amount.
It really is. And when you break down that number, that's where you start to see the strategy.
Okay, so let's do that. How much of that was the reliable recurring stuff, the management fees?
That was the backbone. It came in at $971.8 million. Very strong, very stable.
But that leaves, what, almost $700 million from somewhere else?
Exactly. And that somewhere else is the performance income. That's the accelerator we were talking about.
Break that down for us.
Okay, so you have carried interest allocation. That's their share of the profits from realized investments. That was a huge $464.7 million.
Wow.
And then on top of that, you have incentive fees, which came in at another $100.7 million.
So you combine those, and you're looking at over $565 million in performance-related revenue.
That's right. And what that tells you very clearly is that they were able to find profitable exits during the quarter. The transaction market, seems to be improving for them.
And all that activity, it must have flowed down to the bottom line. What did profitability look like?
It translated directly. Income before taxes hit $652.3 million.
Which gave them a net income attributable to ARES of
$288.9 million. And for the key GAAP metric, the one everyone watches, diluted earnings per share, a very, very strong $1.15.
$1.15, okay. But as you always remind us, with asset managers, GAAP doesn't always tell the full story.
It can't. You have all the noise from unrealized gains and losses in the portfolio. That's why we have to, we absolutely have to look at their non-GAAP metrics. That's what management uses to run the business.
Right. The non-GAAP numbers give us that clearer view of the, let's call it the fortress core of the business. So what did those metrics show?
They confirmed just how stable and efficient that core really is. Let's start with fee-related earnings, or FRE.
Okay, and just to remind everyone, FRE strips out all the performance income. It's just the pure recurring management fee business.
Exactly. And FRE for the quarter reached $471.2 million. So that tells you the core business is incredibly profitable and efficient.
And what about realized income, or RI?
RI, which adds back the realized performance fees but still excludes the unrealized volatility, was $455.5 million.
Hold on, that's an interesting detail.
Yeah.
FRE was $471 million, but realized income was a bit lower at $455 million.
That is a very sharp observation.
So even though they had this massive $565 million in performance fees, the total distributable income was actually a little less than the core operating metric. What does that imply?
It implies that generating that performance income is expensive. You have compensation tied to carried interest, other associated costs.
Yeah.
So while it drives the headline revenue, the pure operating leverage of the management fee business, the FRE, remains the most reliable indicator of their predictable earnings power.
Got it. And the key shareholder metric, after-tax realized income per share.
That came in at $1.19, so it successfully cleared the GAAP EPS of $1.15, and it confirms the strength of the cash flow they can actually distribute.
Okay, so that's profitability. But scale is really ARES' superpower. Let's look at the assets and available capital as of September 30th. Just how big is this machine now?
It's massive, and it's getting bigger fast. Total assets under management, or AUM, swelled to $595.7 billion, almost at that $600 billion mark.
But the number that really matters for revenue is fee-paying AUM, right? FPAUM.
That's the one. And that hit $367.6 billion.
And I remember from the presentation, management was very keen to point out the year-over-year growth there.
Oh, absolutely. They highlighted a 28% year-over-year increase in FPAU.
And that 28% is a critical number. It's not just that the total pile of assets is growing.
It's that they are successfully converting those assets into revenue-generating machines, new funds deploying capital, acquisitions. It's all feeding that recurring management fee base.
Okay, and for future growth, we have to look at the dry powder, the capital they're sitting on. How big is their war chest?
It's enormous. $150 billion in available capital.
$150 billion. I mean, that's just stunning.
Yeah.
But is that a strength? Or is it a potential liability if they can't put it to work?
It's absolutely a double-edged sword. On one hand, you have incredible power in the market. You can do any deal anywhere.
But on the other hand,
Deploying $150 billion responsibly without lowering your standards in a competitive market, that is the single biggest execution challenge for management right now.
let's talk about the growth that's sort of baked in already, the AUM that's not yet paying fees.
Right. This is a vital metric that people often miss. At the end of Q3, they had $81 billion available for future deployment. This is committed capital just waiting for a deal.
And what's the potential fee generation from that $81 billion?
They estimate that if it were fully deployed, it would generate an additional $778.7 million in annual management fees.
So almost $750 million in future recurring revenue just waiting to be switched on.
It's a powerful story for predictability.
Yeah.
And that's not all. There's another $4.6 billion in development assets, mostly in real estate and infrastructure, that aren't stabilized yet.
Meaning once they're built and leased up, they also start generating fees.
Exactly. So that pipeline is just huge. It almost guarantees FPAUM growth for the foreseeable future, even before you consider new fundraising.
Speaking of fundraising, let's pivot to that. They raised a total of $21.5 billion in gross commitments in Q3 alone. That's a huge number for 3 months. Where did it come from?
The credit group continues to be the absolute powerhouse. U.S. direct lending was the star, raising $8.1 billion.
And can you break that down?
Sure. $3.1 billion of that came from their Strategic Income Fund, ASIF, and another $1.4 billion from ARES Capital Corporation, ARCC. It just confirms their dominance in that space.
And what about Europe? Are they seeing similar strength there?
Just as formidable. European direct lending pulled in $4.7 billion. That included $2.9 billion in debt commitments for their newest European credit fund, ACE6.
And the rest.
Another $1.3 billion for their open-ended European direct lending fund. So they're hitting it from both sides, the traditional closed-end funds and the more flexible open-ended vehicles.
Now, what about some of the newer growth areas like secondaries? How do they do?
The secondaries group showed exceptional momentum. They pulled in $1.9 billion for their ACES third fund, bringing its total to $3.4 billion.
Which is a huge vote of confidence from investors, especially in this environment.
It is. The secondary market is a really strategic place to be right now. And on top of that, the private markets fund, APMF, raised another $1.7 billion.
So given this incredible fundraising pace, what was the big message from the CEO, Michael Arrighetti?
His message was unequivocally bullish. He stated with a lot of conviction that ARES expects to meaningfully exceed their old annual fundraising record of $93 billion.
$93 billion. So they're expecting a record year. That's a huge statement.
It's a massive statement, and it really hinges on their product depth and their global reach.
Let's get specific about the funds. Which ones closed in Q3 and are now set to start generating fees?
We saw several major milestones. The big one was the third infrastructure secondaries fund. It closed with 3.3 billion in equity commitments.
Which creates an even larger pool of capital, right?
Right. When you add in the related vehicles, it's a $5.3 billion pool of capital. And here's the key part. That's 3 times larger than the fund that came before it.
3 times larger. That's not just growth, that's market share capture. It really validates their acquisition of GCP.
It absolutely does. They also closed their first ever specialty healthcare fund that secured 1.5 billion in capital. A big move into a very attractive sector.
And what about for Q4? What's coming online soon?
The big one for Q4 fee income is ACF 7th. That's their flagship corporate private equity fund. It had its final close at 3.8 billion, and management fees for that officially turned on November 1st.
A guaranteed boost to Q4 FRE. So they've engineered this pipeline perfectly. What's next? What funds are still raising?
The pipeline is still loaded. Their third special opportunities fund already has over 5.9 billion closed. They're also launching their 7th special situations fund in Asia, a 10th real estate secondaries fund.
There's that secondaries theme again.
It's a huge focus. And very notably, they're launching a new large global digital infrastructure fund. So they're covering basically every major alternative theme you can think of.
You mentioned digital infrastructure, which feels connected to the wealth channel. That's really changing the game for asset managers. What was the update there?
This was a really standout strategic update. They officially raised their AUM target for their semi-liquid wealth products.
These are the funds for high net worth individuals.
Exactly. The old target was $100 billion by 2028. They just raised that to $125 billion.
Wow, raising a multi-year target by $25 billion. That's a huge signal of their confidence in that retail channel.
It tells you they view this as a permanent structural shift, not just a cyclical trend. And it all feeds back into the stability of the model because these products are almost all perpetual capital.
Before we move on to the quarter-over-quarter comparison, let's just touch on the macro view. Management was very clear. They think credit markets are healthy. How are they backing that up, especially given all the headlines about risk?
Erifetti leaned very heavily on their historical data. He kept pointing out that their net realized loss rates are incredibly low.
What's the number?
Just 1 basis point. A 1 basis point cumulative average annual loss rate in their direct lending business over the last 20 years.
1 basis point. But the scale of their business today is so much bigger than it was 20 or even 10 years ago. How can they maintain that?
That's the billion-dollar question. And they answer it by pointing to conservative underwriting. They noted that their U.S. direct lending portfolio companies are showing healthy double-digit EBITDA growth year over year.
So the underlying borrowers are performing well.
They are. And crucially, the loan-to-value ratios, the LTVs, remain very conservative. It's about 42% in the U.S. and 48% in Europe.
Okay, let's just frame that LTV ratio for our listeners. What does a 42% LTV really mean?
Think of it like a mortgage. It means the value of the company, the collateral, would have to fall by 58% before ARES, the lender, even starts to lose a single dollar of principal.
So there's a huge equity cushion below them.
A massive cushion. And that's why direct lending has historically been so resilient, even in downturns. The Q3 data confirms they aren't sacrificing those standards, even with the faster deployment.
Okay, this is the perfect pivot. Let's get into the strategic comparison. Q3 versus Q2. We're looking for that sequential momentum, and it sounds like they found it. Let's start with revenue and profit.
The sequential increase was pretty dramatic. In Q2, total revenue was about $1.35 billion.
And in Q3?
It swelled to that 1.66 billion number we talked about. That's an increase of over $307 million in just 3 months.
So let's break that down. Where did that $307 million come from? Was it the core business or a spike in transactions?
It was a very healthy mix, but it was definitely skewed toward that transactional spike.
So the predictable part, the management fees.
Yeah.
How did that grow?
It grew solidly, up by $71.1 million from about $900 million in Q2 to $972 million in Q3. So that's great. That's healthy deployment.
But that's not the big story.
No. The real difference maker was the performance income, the carried interest and incentive fees.
How much did that soar?
In Q2, performance income was about $347 million combined. In Q3, that figure exploded to $565.3 million.
So that's a sequential jump of almost $220 million in non-recurring income.
It's the clearest, most definitive proof you can find that the transaction logjam broke in Q3. ARES was realizing gains at a breakneck pace.
Which suggests they might have been holding back in the first half of the year, waiting for better market conditions before they started selling.
That's precisely the strategic implication. You preserve value when things are uncertain. Then, when you see a window, a moment of confidence in the market, you execute aggressively to lock in those gains. Q3 was clearly that window for them.
Okay, let's look at the core profitability metric, FRE. Did their costs keep pace with that management fee growth, or did they show good operating leverage?
This is a crucial test of efficiency, and they passed it. FRE saw a very strong quarter-over-quarter increase of $62.1 million,
From what to what?
from $409 million in Q2 up to $471 million in Q3.
So management fees went up $71 million and FRE went up $62 million.
Right, which means only about $9 million of that extra revenue was absorbed by rising costs. That's exceptional operating leverage. The core business is incredibly efficient.
And the key shareholder metric, after-tax RI per share.
That climbed right alongside it. It went from $1.03 in Q2 all the way up to $1.19 in Q3.
That's a 15.5% sequential increase.
A very solid increase. And the GAAP EPS jump was even bigger, from just 46 cents in Q2 to that $1.15 in Q3. Again, just underscoring the huge impact of those realized gains.
All right, let's move to the balance sheet and the activity metrics. We know the scale is huge, but can you quantify the sequential asset growth?
Total AUM grew by a massive $23.3 billion from Q2 to Q3. They are really closing in on that $600 billion milestone.
And more importantly, the fee-paying portion.
FPAUM grew by $18 billion. And the fact that fee-paying assets were such a huge part of the total growth, about 77%, shows just how efficient they are at converting new capital into revenue.
That's capital conversion in action.
Yeah.
Okay, so we saw the fundraising was strong. Did that translate into more aggressive deployment in Q3?
Yes, the acceleration was stark. If you look at gross capital deployment, it went from about $8.3 billion in Q2 to $11.6 billion in Q3.
So an acceleration of over $3.3 billion.
That's right. It completely validates what management was saying about the transaction market rebounding. They were ready and they pounced.
And you can see that reflected in their dry powder, right?
Exactly. That pool of AUM not yet paying fees, the $81 billion we talked about, well, in Q2, it was $86.8 billion.
So it dropped by almost $6 billion.
It dropped because they successfully activated that capital. They moved it from the potential fees column into the current fees column.
Let's turn to the cost side of the ledger. When revenue, especially performance income, spikes that hard, costs like compensation usually follow. Did that acceleration hurt their efficiency?
We saw an increase, but it looks very controlled. JEP compensation and benefits went up by about $16.1 million sequentially.
From $644 million to about $60 million.
Correct. And while $16 million isn't nothing compared to the $62 million increase in FRE, it suggests they're keeping a very tight lid on the core overhead.
A lot of that increase is probably just tied to the new people they brought on from the GCP acquisition or hiring to support all these new funds.
I think that's a big part of it. We also have to look at their financing costs. Did all this activity push up their interest expense?
It seems like it did. Net interest expense at the corporate level jumped from $37.5 million in Q2 to $46.3 million in Q3.
That's a nearly $9 million increase in just 3 months.
What's driving that?
It reflects the growing needs of the corporate entity. You have costs from the acquisition, financing for balance sheet investments, and just general corporate leverage to manage liquidity and fund growth. It's an important detail.
Because while the fee income is huge, the cost of that strategic growth, the leverage, needs to be watched closely.
It has to remain efficiently covered by that recurring FRE stream.
Now, let's look at the fund level debt, the consolidated funds.
Right, and this is mostly CLOs and specific credit facilities within the funds. The filings for Q3 got very specific, listing one facility of about $89 million at a rate of 6.39%.
How does that compare to Q2?
Well, Q2 gave a much broader number, showing total CLO loan obligations of over $8.4 billion. So the takeaway here is really that the fund leverage is massive, but it's segregated from the corporate balance sheet.
Which protects the parent company, ARES Management Corp., from fund-level credit risk.
Exactly. Though, at their scale, they're obviously highly exposed to the general health of the capital markets.
Let's move to a complex but really important area, affiliate receivables. This is the money the funds owe back to the management company. What was the trend there?
It saw a pretty significant increase. Total due from affiliates went from 1.3 billion in Q2 to 1.3 billion in Q3.
A $200 million increase.
And that signifies a much higher volume of transactions flowing through the system, more fees being recognized even if the cash hasn't landed yet.
And where was the most substantial growth within those receivables?
Well, management fees receivable grew, as you'd expect, from about 742 million to 868 million. That just mirrors the revenue growth.
But that's not the flashing sign.
No. The real flashing sign is the incentive fee receivable. In Q2, that number was tiny, just $12.5 million.
And by the end of Q3,
It had surged to $82.8 million.
that spike right there tells the whole story of the quarter.
It really does. It means that nearly $83 million of realized performance income was booked on the income statement. It was earned, but the cash hadn't physically shown up by September 30th. It's the ultimate validation of that aggressive exit activity.
It's a great number to see, but it also introduces more volatility into their cash flow profile, doesn't it?
It does. It's less predictable than the steady drumbeat of management fees, even if it speaks volumes about their performance this quarter.
Okay, let's touch on one more complex liability, the Tax Receivable Agreement, or TRA. This comes from the founders and employees exchanging their private units for public stock. How did that change?
The TRA liability increased by $32 million. It went from about $509 million in Q2 to $541 million in Q3.
Can you just break down what that liability actually represents?
Sure. When those private units get exchanged for public Class A stock, ARES gets a step up in tax basis. This creates a big future tax saving for the company. The TRA liability is basically their promise to pay 85% of that future tax saving back to the people who exchanged the units.
So the company saves $1 on taxes, and they have to pay 85 cents of that dollar to the original unit holders.
That's it exactly. So when you see the liability go up, it means more of those exchanges are happening. It's a non-cash liability, and it's tied to a real tax benefit, but it is a structural mechanism that we have to watch.
Okay, that makes sense. Let's move beyond the numbers and talk about the why, the qualitative context. What market trends did management point to that allowed for this big quarter?
The overarching theme was market stabilization. They noted that private equity activity, which had been pretty much frozen for a year, rebounded sharply in Q3.
And that was fueled by interest rates stabilizing.
That was the key. It allowed buyers and sellers to finally agree on valuations again, which directly enabled all that performance income we just talked about.
They also talked a lot about the real estate market rebounding. The numbers there were incredible. Deployment was up 51% quarter over quarter.
And 78% higher than the same time last year. It was a massive shift in a sector that's been really tough.
What's driving that?
Again, it's the narrowing of that valuation gap. Sellers were stuck on old pricing, buyers were pricing in high financing costs. That gap is finally closing, transactions are happening, and ARES feels they are perfectly positioned to benefit.
What about their credit business? How are they positioned for a world where rates might actually start to fall?
They feel they're exceptionally well positioned. As of Q3, about 85% of their debt assets are floating rate instruments.
So explain why that's an advantage in a potentially falling rate environment.
Well, if rates fall, your income might go down a bit. But two other things happen. First, the risk of your borrowers defaulting goes down because their debt payments are cheaper.
Okay, that's a big one.
And second, historically, when benchmark rates fall, credit spreads, the premium lenders charge, tend to widen. So ARES is confident that wider spreads will mostly offset the lower base rate, all while transaction activity picks up. They see it as a win-win.
That brings us to their core strategic advantage, perpetual capital reliance. This is their hedge against any market cycle.
This is their fortress. For Q3, a staggering 94% of their management fees came from perpetual capital or very long-dated funds.
And that's up from 91% in Q2.
It is. And that small jump from 91 to 94% is strategically huge. It means their core revenue stream is more insulated than ever from short-term market panic or redemption requests.
It gives them the freedom to be patient when they need to be and opportunistic when the time is right.
That's the key differentiator.
We mentioned the GCP acquisition earlier. How did Q3's results really confirm the success of that deal?
The infrastructure secondary fund is the poster child. Closing that fund at 3 times the size of its predecessor, that doesn't happen just through organic growth. That's the scale, expertise, and distribution that GCP brought to the table. It made them an instant leader.
They also highlighted their active portfolio management. There was a specific case they mentioned, a workout situation.
Yes, this is a great anecdote. They had an asset that was on non-accrual, meaning it wasn't paying its interest. It was a problem credit.
What did they do?
They restructured the debt, converted their position into equity, and then managed the company to a successful sale for $260 million.
And the return.
They generated a 15% IRR on what started as a troubled loan. That's turning a potential loss into a private equity-style win.
It really highlights that they're not just passive lenders.
Not at all. It's why their historical recovery rates are so high, 93% in the US, 95% in Europe. They have the teams in place to get their hands dirty.
Okay, let's shift to shareholder capital. Did the dividend policy remain consistent?
It did. They declared a dividend of $1.12 per share for Q3, which matched Q1 and Q2.
Which is intentional, right? They tie the dividend to their stable earnings, not the volatile performance fees.
Exactly. They align it with their expected after-tax fee-related earnings, prioritizing that predictable stream for shareholder returns.
What about the share count? Dilution is always a concern when a company grows this fast.
And we definitely saw issuance. The Class A common stock count went from about 200 million shares at the start of the year to over 216 million by the end of Q3.
So about 17 million new shares. Where did they come from?
The main driver was about 10.7 million shares issued for things like the GCP acquisition and those ongoing AOG unit exchanges.
And the rest.
Another 2.9 million from vesting employee stock awards. So the question for an investor is whether the massive growth they're getting justifies that dilution. And looking at Q3, management would argue it absolutely does.
Let's wrap up with some of the final announcements and risks. First, this Promote Giving initiative. What's that about?
This is really interesting. It's an industry movement they're leading where they commit to donate a portion of the fund's performance fees, the carried interest, to charity.
How much has been pledged so far?
Over $45 million from their Pathfinder series of funds alone. And half of that is coming directly from employees. It's a huge tool for talent retention and for appealing to large ESG-focused investors.
They also made a very specific point about their size relative to the S&P 500.
They did. They explicitly noted that ARES is the largest eligible financial company not in the S&P 500 index.
Which is not just a fun fact.
It's a signal. They know that eventual inclusion in the index would trigger a wave of buying from passive funds, providing a big lift to the stock. They're basically flagging a future catalyst for shareholders.
Finally, let's revisit risk. Management calls recent bankruptcies idiosyncratic and isolated.
Yeah.
Is that fair? Or could the spike in their own realized gains be a sign that they're rushing for the exits before a potential downturn?
That is exactly the skeptical lens you should use. While they maintain confidence publicly, you have to view that dramatic acceleration in exits as, at least in part, opportunistic risk mitigation. They are taking profits off the table while the market is strong.
And their defense against a future downturn.
It comes back to two things: their fee-centric model, which insulates their balance sheet, and that massive pile of credit dry powder. Michael Arrighetti said it's among the highest, if not the highest, in the industry.
So they can go on offense when everyone else is playing defense.
That's the plan. They can deploy capital into a distressed environment at very attractive valuations.
And of course, the formal caveats about global economic and political risks remain.
As always, they acknowledge that their results are tied to the health of the markets in the US, Europe, and Asia. So, to synthesize the key insight from Q3 2025, ARES really performed a highly successful balancing act. They reinforced the stability of their base with that robust FPAUM and FRE growth, all anchored by that 94% perpetual capital metric. At the same time, they showed their agility, aggressively capitalizing on the better market to generate that huge spike in performance income. It's clear that acquisitions like GCP are firing on all cylinders.
This quarter really does present a fascinating strategic tension. You have the fortress of stable fee-related earnings, which is stronger than ever. But the growth engine, the thing that drives the stock, relies on these less predictable parts. So considering that incentive fee receivable jumped from 12 million to over 80 million, and the fact that they have to issue stock to fuel growth, how should you weigh the safety and predictability of ARES' core earnings against the increasing cost, volatility, and dilution that comes with being a high-growth, opportunistic performance machine? That dynamic tension is what defines the ARES investment thesis right now.
With that, we conclude our coverage for this deep dive. Thanks for joining us. Sheen Research. Mindful markets, measurable meaning.